from New York City.
We're here in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics? The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City for our audience worldwide, good morning, good morning. Following a massive weekend, futures down 1.4% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue. A lot has changed. Ukraine officials arriving at the Belarus border for a high-stakes meeting with Russian counterparts. President Zelensky still skeptical, saying, I don't believe that much in the result of this meeting, but let them try. So not a single citizen of Ukraine has any doubt left that I used every chance to stop the war. Talks coming following Western allies sanctioning Moscow's central bank and cutting off various lenders from the critical SWIFT messaging system. Jen Psaki suggesting the U.S. could go further.
We want to take every step to maximize the impact and the consequences on President Putin while minimizing the impact on the American people and the global community. And so energy sanctions are certainly on the table. We have not taken those off, but we also want to do that and make sure we're minimizing the impact on the global marketplace.
President Putin responding, saying, quote, I'm ordering the defense minister and chief of general staff to switch the Russian army's deterrent forces onto a high alert mode of combat, standby duty. Team coverage starts right now with AMH from the White House and Bloomberg's Maria Tadeo in Geneva. A fast-moving weekend, AMH, and some news this morning too.
Yeah, that's right. Russia remains even more isolated this morning, Jonathan, off the heels of what Governor Elvira Nabiullina said over in Russia, that today the financial industry is just not working as it should be. I think you called an understatement of the year. What we're hearing from the U.S. administration is more details about the sanctions that came this weekend. Right now, they are banning any U.S. investor, any business from dealing with the Central Bank of Russia, their National Wealth Fund, and the Finance Ministry. This is what Treasury Secretary Janet Yellen said in a statement. The unprecedented action we are taking today will significantly limit Russia's ability to use assets to finance its destabilizing activities and target the funds Putin and his inner circle depend on to enable his invasion of Ukraine. Jonathan, the U.S. administration, when they talk about those funds, they're talking about that $630 billion reserves war chest that President Putin has built up over the years.
Maria, let's do two things. Let's start with the effort at the border with Belarus right now, the negotiations that are ongoing, and let's talk about the effort where you are.
Yeah, Jonathan, and you talked about the isolation of Russia. Well, let me give you a very real life scenario that is happening here. Today in Geneva, there is a United Nations Council. The Russian Foreign Minister, Sergei Lavrov, was supposed to participate, and that is the reason, in fact, why we're here. Now, we're finding out from the Russian delegation that Mr. Lavrov is not going to be attending this meeting. There's a number of reasons for this. One, of course, is that we're seeing a diplomatic isolation of Russia in many ways from the West as a form of protest to the attack that we've seen in Ukraine. The other one, of course, is the practicalities of the sanctions that have been approved already. As you know, the airspace in the European Union is shut to Russian planes and Russian registered flights. It's also worth noting that Mr. Lavrov himself is now personally sanctioned by the United States and the European Union. So this is the real life impact that these sanctions are having all the way to the Russian political elite. Now, when it comes to the talks happening on the the Belarus border between the Ukrainian delegation and the Russian delegation. Look, both sides said we want to talk and there's no preconditions going here. But the Ukrainians have made it clear if Russia wants a total capitulation, they're not going to get this. And by the way, we need to see a ceasefire and Russians pulling back their troops. So again, these are very difficult talks, but you need to factor that for the Ukrainians, they really do feel the tide is turning and they're not just going to agree or concede to anything that the Russians put on the table.
Crude up this morning by 3%, Brent at 101. Anne-Marie, WTI at 95.70. We're off session highs because there's some talk this morning of a repeat of last year, a reserve release. What are you hearing?
Yeah, potentially we could get a strategic petroleum reserve tap from the United States, but also, Jonathan, they would likely repeat what they did last year, which is making sure they can coalesce other consuming countries which are struggling to also dig into their reserves. So they would do this coordinated release to make sure they could try to at least at some measure tamp down the pressure on the oil market, because we all know domestically this is a very important and significant issue for the president, especially as the Democratic Party gears up to try to maintain some seats ahead of the midterm elections. Jonathan, we should also note what is happening right now with the sanctions. The United States is trying to have a carve out on some of these banks for energy trades. The issue is, what I'm hearing from talking to a number of people in the industry, is they might self-sanction.
Yeah.
Why would a bank want to go do business? It's going to be very difficult. And not only that, the natural gas market might be a little bit different, but try to find, is what I'm being told, try to find a ship or a tank to want to go pick up Russian crude right now. The freight rates are incredibly high, and this is all adding to that price premium you're seeing in the oil market.
The theory meets reality, and that's the reality at the moment. AMH down in D.C. Anne-Marie, stay close. We'll catch up with you through the hours. Maria Tadeo of Bloomberg out of Geneva this morning. Thank you. Dollar ruble, a move of 32%, 110 right now on dollar ruble. Understatement of the year comes from the Russian central bank governor, who said this morning, quote, the financial system is facing what she calls a non-standard situation. To talk about that non-standard situation, joining us now is SocGen's Subhadra Japa, John Hancock's Matt Miskin, and Ashok Bhatia of Neuberger Berman. I want to come to you, Subhadra, first, and ask you whether your base case now is a Russian sovereign default.
I think it's really hard to know, but you're going to see this isolation only build up, and this is not a situation that's going to resolve itself anytime soon. So really what you're seeing in the markets, broadly speaking, is exactly what you would expect, which is sort of a readjustment, if you will, from Thursday to Friday, where we saw a little bit more optimism, to something that's going to be much more drawn out. So, you know, definitely that's a possibility. Things seem to be heading towards a more dire situation in Russia, for Russia. But broadly speaking, I think the market is going to take it in stride, because there's really not that much of a, you know, bigger impact for, you know, the U.S. economy. I think the impact is going to be much more on Europe. But even there, broadly speaking, I think the impact is going to be muted. You're seeing a near-term flight to quality into treasuries, as well as the sell-off in equities. But we'll have to see. This is not a one-day resolution. It's going to be over the next several months.
Ashok, there's a range of unintended consequences we could explore. What's your base case now?
So base case is, I think, 3 quick points. You know, first is this is a major event for Russia. Obviously, we've gone from, you know, part of the global economy to effectively being cut off from it and the banking system in 24 to 48 hours. And, you know, questions about Russia default, local debt, currency rates. I mean, this is a sudden stop in the Russian economy. I think, you know, the second, though, is that the recession risk that comes from this for the global economy, it still remains pretty low. Global economy enters this event at, you know, with pretty strong underlying growth, and there are still policy mechanisms. You know, you've been talking about the crude oil release that can mitigate some of these impacts. So low probability of big contagion. And then third is we think there will be a central bank change. We think peak hiking expectations are done. You know, not that the Fed still won't hike, but we think we're going to gravitate back to something like 4 hikes rather than 6 to 7, ECB on pause. And so that will help provide a little bit of stability. But overall, this is really, you know, focused on Russia, and this is day one of sorting out those implications.
And Matt Miskin, as Ashok points out, it's day one. And when you look at dollar ruble, I caught up with someone out of the City of London this morning who basically said this is not a proper market. And it's not a proper market until foreign holders of Russian assets can actually sell into it. Right now, they can't. We heard from BP over the weekend they want to dump their Rosneft stake. OK, we've got to work out and see how that plays out in the coming weeks and months, Matt. Have we actually seen the move from the weekend's events? Have we actually seen the move yet this morning?
Still think you need the dust to settle more, and you can't mark to market certain assets right now because they're not even trading. So there's going to be more of a discount likely built in. To us, this is not the time to be unloading assets. You're seeing selling at any price right now. People just want out, and investors just want out. That is not usually a good time. We would be providers of liquidity versus takers of liquidity in this type of a market. But our positioning is we would lean more in the U.S., look for value in the U.S., healthcare, industrials, more broadly in terms of sector exposure, focus more on quality. We'd be concerned with the European banks here. We think there's going to be more connection there with this conflict. And so you want to be very mindful in terms of risk management, taking European value exposure here in the financial sector.
The hope was that we get an ECB rate hike, and that's what pushed some money into the European lenders through much of this year. Now the pullback is brutal. UniCredit down by 12%. Raiffeisen out of Vienna, Austria, that is down by more than 15 percentage points. Subhadra, I am no expert on the plumbing of the financial system. Zoltan Pozsar of Credit Suisse is. This is what he wrote over the weekend. I think we all reached for that note over the weekend, and this is what he said. Banks' inability to make payments due to their exclusion from SWIFT is the same as Lehman's inability to make payments due to its clearing bank's unwillingness to send payments on its behalf. History does not repeat itself, but it rhymes. Does this rhyme with anything dreadful that's taken place in markets, Subhadra, over the last 15, 20 years?
I think this is a very unique situation, right? I think in the case of Lehman, it was the company's inability to meet its obligations. Here, Russia has just been cut off from the financial system, so to speak. So this is a very unprecedented, type of action, global action, if you will, but one that's much more impactful on Russia than all the other countries in the world because of the fact that it's going to be, the Fed is going to be able to step in, provide dollars if there is a need for dollars. It's going to be able to perhaps help industries that are most, impacted by direct connections with the Russian economy, and same with other central banks like the ECB. So I think this is a very unique situation, and for the most part, I think the exposure for the U.S. The Russians don't hold a lot of treasury debt. It's mostly all in dollars and in the FX market. So the impacts are going to be localized in certain FX markets and not broad brush impact, if you will.
We'll work our way through these issues into the open and bow. Futures right now, well off session lows, down by 1.3%. Sticking with us, Subhadra Japa, Matt Miskin, Ashok Bhatia. Looking at the equities this morning. Let's get you some stocks ahead of the open and bow. Here's Kelly Lyons.
Well, John, we have to start with one in particular that you mentioned, and that is BP. Those ADRs moving lower by about 7% in pre-market trading. The company weighing reputational risks about keeping that relationship with Russia's Rosneft oil and deciding it is better to just offload that stake. So that stock is down. The question really is, does this mean selling it? Can they find a buyer? And if it just means walking away, does that mean a $25 billion write-down for the company? Also moving lower to a way larger extent is Yandex. This is a Russian internet giant that is listed here in the States. It's already down 65% over the last 6 days. It's lower by more than 20% this morning. So that is a seventh day of really heavy losses. You have the banks feeling the heat this morning as we're seeing that bid for haven in the Treasury market. Yields coming lower. That's taking down the likes of JP Morgan and Citigroup. And you're also seeing some leasing companies moving lower as well. AirCap, one of them, because of the sanctions as they relate to airplanes and Russia, that could be a huge threat to that company in particular that has about $2.5 billion worth of assets in Russia and Ukraine. So that stock also taking a leg lower in early hours, John.
Katie, thank you. One big focus for us through this morning, self-imposed restrictions. This from Reuters and BP. BP cancelling fuel oil loadings from the Russian Black Sea port. That again from Reuters. BP cancelling fuel oil loadings from the Russian Black Sea port. More on that a little bit later this morning. Coming up, investors placing their bets on the Fed's path to tighten amid escalating geopolitical tensions.
At the end of the year, I suspect we'll end up with 4, maybe 5 hikes at most, and inflation will still be running hot. Inflation expectations will be an issue.
That's next. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Earnings season continues.
To the Metaverse, to Spotify, to Qualcomm and beyond.
Bloomberg is fastest with the numbers and analysis.
Peloton becoming a proxy for this pandemic.
I think there's tremendous opportunity.
Bloomberg, the fastest numbers and analysis you trust.
Minutes away from the opening bout, just getting some breaking news from the finance minister. Ukraine to auction the first war bonds on March 1st. That headline just crossing: Ukraine to auction the first war bonds on March 1st. What does all of this mean for the Federal Reserve? This is the take from Federated. Here's the quote. This conflict implies a further deterioration of the already tricky growth inflation trade-off central banks have been facing. It is fair to say that the crisis increases the room for central banks' policy mistakes. With more, here's Mike McKee. Morning, Mike.
Good morning, John. Well, we just don't know what the scope is or how wide the error band is for the central banks of the world. But you take a look at what's happened the last couple of days, and markets have started to price out more aggressive tightening. You can see the Bank of England and the Fed are still expected to be raising rates, but not as far as they were, say, a week ago or so. And you can see that at this point, the European Central Bank isn't expected to do anything. That kind of pushes against the idea that by the end of the year, they would be raising rates. It's all going to depend on what happens. And again, too early to tell. The one thing the Fed may get involved in is something you were talking about a little earlier, and that was Zoltan Polzer's comment over the weekend, that he thinks that the Russians, after they sold treasuries, put all that money into Forex swaps. And as they are a counterparty now and nobody can they can't sell anything, there is a good possibility of defaults. And you can see the forward rate agreements and OIS chart there. That's a measure of bank instability, and it spiked today. There is concern about a demand for dollars, a shortage of dollars out there, and the Fed may be forced, according to Polzer, to make some available, to increase liquidity, which might raise the size of its balance sheet at a time when they're trying to shrink it. Now, there is data this week that isn't going to make a whole lot of difference given the larger context of the world. We get ISM manufacturing tomorrow. The big news is going to be Jay Powell speaking on Wednesday and Thursday, the testimony known as Humphrey Hawkins. He will give us the latest thinking at the Fed over what this is going to mean for the U.S. economy, and a lot of that's going to depend on what it means for economies in Europe. And then on Friday, of course, Jobs Day, but that's going to be really overshadowed by the war at this point.
Not even talking about it at the moment, are we, Mike? Thank you. 400K, the estimate this Friday. Here's the take from Citi. For them, not much has changed. The quote as follows: despite elevated uncertainty, we have not changed our base case outlook for 100 basis points worth of rate hikes by the June FOMC meeting. We do not see geopolitical developments as they stand now as taking the possibility of a 50 basis point rate hike in March entirely off the table. Ashok Bhatia, I want to come straight to you. You mentioned this briefly. You do think it changes things?
Yeah, we think 50 basis points is off the table. I mean, that was unlikely to begin with, and think it's off the table now. And the reason is, the last few months, the markets and the Fed have been, able to 100% focus on the inflation risks. And so policy has been driven about the response to elevated inflation, and it's led to, escalating, hike expectations. And now we think this is going to introduce some downside growth risks. We don't think it's significant. We don't think it's going to be material, but the central banks are now going to have to be a little bit more balanced on growth versus inflation. The other element of this is that, the Fed and other central banks have stopped talking about transitory inflation, but it doesn't mean that they still don't, in the back of their minds, think that's a possibility. And this will allow that to kind of re-enter the dialogue a little bit. So net, the central banks are going to hike. We think this actually reduces the chance of a policy mistake from the Fed and other banks. Hiking cycles can be more elongated rather than accelerated. And that ultimately, is a bit of a positive for markets.
So Badri, your take?
I think I agree with that. I think, having 7 hikes by the end of the year seems very, very aggressive. We're still on the camp that the Fed will hike rates 5 times. And introduce some sort of a balance sheet unwind or runoff, announcement in the middle of the year. That balance sheet runoff could be quite large. You're looking at perhaps $100 billion a month, capped, $1.5 trillion over the next year and a half. And broadly speaking, the curve is very, very flat. The 2-cents part of the curve is around 40 basis points. I think an aggressive path of rate hikes is going to flatten out the curve even more. So I think they're going to be very, very mindful of developments, not just on the geopolitical front, but also on what the impact of tighter monetary policy is going to be on growth. And they don't really want to slow down growth. They want to see a prolonged period of expansion. So they'd much rather spread out those hikes over the next few years.
The Goldman team and Jan Hatzius came out this morning and raised their inflation outlook. Matt, what was interesting for me is not just the inflation outlook, they threw in an extra hike for next year as well. So for their 2023 inflation outlook, that's up. 22, that's up. And a slightly higher terminal Fed funds rate at 2.75 to 3. Matt, what's been interesting for me, just going across bank to bank over the last week, is that not many banks have actually changed their call on the Fed, even though this has all played out through Europe.
I don't think it makes a lot of sense. I think you do have to adapt. I think if Powell says he's going to be nimble, and that was the big tagline of this whole thing, and then you have this massive geopolitical shock to the system, and then saying they're not going to be nimble. I think that's you're not catching the biggest takeaway here. And I do think they're going to pivot. Oddly enough, the curve is steepening. I mean, I think there's been some really good points here that we think 4 to 5 rate hikes is about right. We think that the curve is really flat, and that if they did go 50 basis points, you'd likely invert the curve very shortly thereafter. And so the odd twist to this is that the curve's steepening while everything else is looking at this risk-off environment. And I think that's telling you the bond market's saying, hey, if the Fed doesn't aggressively hike here, it means they're not going to make a policy mistake. And it could mean that this cycle is actually elongated because we're having this, pause here in risk assets and volatility. But it could actually mean that they do not make a policy mistake, which would be better overall for the economic cycle.
Ashok, I was just going through the 3 points that you made in the last 30 minutes, that the peak of central bank tightening expectations has perhaps passed. You also said commodities would contribute to elevated inflation for longer in your notes. And the third point, the markets will begin to price increasingly towards negative growth outcomes. Are the first two compatible, Ashok? This idea that we will have more persistent, higher inflation, but expectations for a more hawkish Fed have perhaps passed?
Yeah, because I think the way you reconcile that is that although inflation may remain more elevated for 6 months or 12 months, it allows the central banks to have a bit more uncertainty, and there is a bit more uncertainty about how transitory that is. This does increase the chances. You were talking a little bit about, is Russia going to default on its debt? We've got the bonds are certainly putting a significant probability on that. There's an interest payment coming up in March, mid-March, which we'll have better visibility about.
Yeah.
So these types of things are introducing that growth dynamic, which increases the possibility of slower growth outcomes in 2023 and 24. And I think we think allows the bank to think about this elevated inflation as perhaps transitory from a little bit more of an intermediate time frame. So it's going to be volatile, and it's going to be a bit of threading the needle from the central banks. But I think those two can be reconciled.
You are now listening to Young Checks.
When you were sleeping on trains and you're homeless and your mum's kicked you out and all them thing there, people would have loved to show you. So now that you're doing your thing and you're going in, stay.
Done a graveyard shift last night, woke up today, got straight back to it. Done a graveyard shift last night, woke up today and got straight back to it. Took me an L, no problem, I got on my grind, got straight back to it. Had to handle a call in the middle of G and I put down my phone, got straight.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Equities are lower here. Let's get to your morning calls. First up, BMO upgrading Dollar Tree to outperform, highlighting a favourable risk-reward with consensus expectations too low. UBS downgrading AbbVie, struggling to see any meaningful upside after the stock's recent outperformance. And finally, Wolf Research upgrading Lockheed Martin, expecting stronger international military spending given the developments in Ukraine. Up next, oil surging on another round of sanctions, adding fresh momentum to the market's top-performing sector this year. That conversation up next.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
25 seconds away from the opening bell in New York City this morning. Good morning. Kicking off a brand new trading week with equity futures down by 1.25% on the S&P, on the Nasdaq down by 1 percentage point, on the Russell down a single percentage point this morning. Good morning to you all. The opening bell in New York City rings. Switch up the board and get to the bond market. Yields look like this. They come in down 8 basis points on 10s, at the front end even more so. On 10s right now, 188.36. It's a break to the downside of 190. Euro dollar, dollar strength, the story out there. Euro dollar 112.12. Negative 0.5% on that currency pair. Crude, $95 and about 7 cents. We're positive there, 3.8%. 15, 20 seconds in, we're negative 0.7% around the opening bell on the S&P 500. Energy top of the pile, the relative outperformance there, we're negative 0.2%. Every other industry group on my screen at the moment in negative territory. Early days, of course. We're down 1% on the S&P now. Let's get you some single names around the opening bell. Back with us, here's Kaylee.
Well, John, among those big laggards in the equity session are consumer stocks, specifically those that are exposed to Russia. The likes of Anheuser-Busch and McDonald's, for example, they're both moving lower by about 5 and 2% respectively. You also have the banks under some pressure as we see a haven flight into the Treasury market, bringing yields lower. That's not great for the names like Citigroup, which is down about 3.4%. You also have tech getting hit, but relatively less so than the broader market. Nvidia is only down about 0.4% right now. What's interesting is in addition to energy, your outperformers today have been defense stocks, given a boost by Germany boosting in a massive way its defense spending, prodding the idea that maybe countries around the world will follow suit given the crisis in Ukraine. But all of these defense stocks are off of their pre-market highs. Sure, Lockheed Martin, Raytheon, General Dynamics, Northrop Grumman, they are still higher by about 1% or more, but they had been significantly higher in early hours this morning, John. So we're seeing them lose a little bit of steam at that opening bell with stocks broadly down on the day, John.
Very focused on some of these energy names stateside as well. Kaylee, thank you very much for that. Given what happened with BP over the weekend, looking to drop its Rosneft stake, which is worth close to 20% of the company, half of its reserves, a third of its production. Just get your head around that. For BP, that stock is negative just 5.5%. I say just because given the story we're discussing right now, we're down just 5.5% on the BP story. It doesn't sound like a lot. 357 over in London trading. I want to touch base with Anne-Marie down in DC to catch up on this story of the moment. AMH, it's these talks on the border in Belarus. Have we had any indication that they have wrapped up? Have we heard anything about the outcome of them?
No, we're still waiting for that, Jonathan. At this moment, standing at the White House, I have no indication about even the sentiment of those talks. Are they in good faith and what is potentially the outcome? But we do know that Ukraine has gone into them really wanting a last-ditch effort to avoid this war, not avoid, end this war, because the war is happening and Kiev is completely being encroached. And this is something Ukraine wants to avoid at every moment. What I can tell you from here is that we are waiting for the president to get back from Delaware, where he spent the weekend. He should be arriving this hour. And then at 11:15, Jonathan, he'll be talking to a number of other leaders and allies about this crisis and their updates off of the heels of the fact that we got more information about the sanctions and penalties the U.S. and the West are really slamming on the Russian economy.
I'm going to talk about energy in just a moment, AMH. I'd love your view on a couple of things, and that's climate change. The Polish speaking at the moment, saying that the EU climate policy needs revision. Now, one thing that I've been wondering, Anne-Marie, is whether it accelerates the transition or in some cases, in some countries, reverses the transition as they try to wean themselves off depending on Russia for oil and gas.
It's a great question. When Jen Psaki was asked about it on ABC this week, and she said energy was on the table, something the administration has avoided to say because of how important Russia is to the global energy market, being the second big exporter of crude. She said that part of this is also a fact that us and other countries need to realize that we need to lessen our dependence on, especially for Europe, not just fossil fuels from Russia, but also fossil fuels in general. The issue is, Jonathan, is especially in Europe, natural gas was really going to be that fossil fuel that was the link for the energy transition. And this is critical for Germany because over the course of the last decade, they have been shutting down their nuclear sites. So they are ever more attached to that Russian energy. But over the weekend, we had a historic speech from Olaf Scholz. And so much of that was about defense spending. They want to hit that 2% target. This is an absolute reversal. I think one of the most paramount issues coming out of the weekend was that speech. But also, that's not getting a lot of attention, is he talked about energy and how they need to build more LNG storage facilities. That would mean they can have more shipments instead of taking some from the Russian pipelines.
MH, as always, stay close for breaking news. Anne-Marie down in D.C., a headline from Chevron. No current operational impact from Russia's invasion. So for Chevron, they say no current operational impact. That's the headline from them. Here's the quote from Goldman's Jeff Currie this morning. Says the following: commodity markets need to reflect not only these difficulties in paying for Russia's exports, but with little left to sanction, the risk that Russian commodities eventually fall under Western restrictions. So Badra Japa, Matt Miskin, Ashok Bhatia is still with us. Matt, I'll come to you on that. Is that your base case, that that's where this ends up? Because I've thought about it in theory. In practice, it seems like some people will self-impose those kind of restrictions, sanctions on themselves anyway. Do you see it heading in that direction?
It's going to be really hard to do. I know that it's probably the right thing to do in a lot of countries to sanction Russian energy, but they're going to be so dependent on it. What you really need to see is OPEC plus the rest of the oil-producing community step up and bring more barrels to market. We think you see that. You see, the Middle East bring more oil. Their production is still not back above where it was pre-COVID. So we've got to get that back up and running. We need the United States to actually increase its oil production, more rigs, more oil production in the United States. And we need to fill this void. It's going to really dent the global economy with oil prices this high and the geopolitical risk that is now being priced in across markets. We need energy back. And that's something that's going to have to happen without Russia helping much at all.
Well, the team at Goldman are doubtful. They're looking at 115 on Brent, 1 month price target up from 95. This was a line that jumped out for me, Ashok, in the research, and I think this will resonate with you. Barring a breakthrough in peace negotiations, we believe this leaves commodity prices having to rally sharply as we see demand destruction as now the only significant remaining balancing mechanism. Ashok, let me repeat that, and I'll ask you if you agree. That demand destruction is now the only significant remaining balancing mechanism. Do you agree?
Yeah, I think just with a couple of caveats. I mean, there are a few things out there that could also help. There is some discussion that perhaps there's an Iran deal that could bring, a few million barrels onto the market. There's also, the potential for some strategic releases, which the variety of crude they hold, there's certainly refinery issues there, though. And then third, though, this is a big, chip for a potentially negotiated settlement. The central bank restrictions on the Central Bank of Russia, the U.S. released its, the official documents this morning and are trying to carve out energy producers. In practice, that could end up being a lot harder than we think people expect. So that may be something that, if we can get to a negotiated solution, could come off. So, but I think generally that point that demand destruction is going to be a significant issue going forward, and sort of the balancer is accurate.
The quote from Amundi that I think it'll be of interest to you as well, Subhadra. Rising oil is a major source of inflationary risk at a time of already hot global inflation. Then they use the S word, the risk of stagflation globally is now higher. I've heard that word a few times, Subhadra, stagflation. Do you think that's the right word to characterize the environment we're about to go into?
Well, we've heard that from one of the ECB members, right? So Definitely there's a preoccupation on what the impact of persistently higher inflation is going to be on growth, and that kind of points towards that sort of scenario, although I think broadly speaking, growth in the U.S. is going to be okay this year, anywhere between 3.5% to 4%. Ironically, this whole green transition is going to require more commodities, more oil, more copper, all of the other commodity complex. Demand is going to go up because of the green transition. We're just not there yet to be able to fully transition to a green world. So, during that time, during the transition phase, there's going to be quite a lot of demand for a variety of commodities. And if you assume that the Fed's going to be somewhat more cautious on its path of rate hikes and not deliver 7 rate hikes this year, then there's a chance that inflation expectations remain, relatively high. The Fed might err on the side of letting inflation run a little hotter so that they don't really stymie growth. So in that sort of scenario, I think that inflation expectations, the rising inflation expectations, is possible over the near to medium term. The green transition is going to take several years, so I think that the dependency on commodities and oil is going to be here to stay, at least for the next couple of years.
That transition's getting more expensive. Ashok, just to leave the macro stuff to one side and just get to a final question for you. When you work through the portfolios, you speak to people in markets right now, do you get the impression they still have Russian exposure to sell? Does that come up a lot in conversations? Because this morning, that's what it's about for a lot of people. They're looking to the foreign investors that haven't been able to sell today, and I'm trying to work out if this move is really that cathartic move or whether that's still further down the road.
Today is the day, I think, folks and portfolio managers and clients are working through what is their Russian exposure? Are you legally able to sell it? And if so, how do the mechanics of that work? And then the second issue, the last issue is there a bid for this? Certainly, the indications we're getting is that the volumes that are being able to be transacted in the currency are pretty limited. Hard currency bonds, less liquidity. So our best guess is that we're going to enter a period where what people own in Russia is likely kind of remaining on people's books. And there's not going to be a lot of back and forth and trading of these assets for the near term.
Ashok Bhatia, appreciate your time as always, sir. Matt Miskin, Subhadra Japa, thank you. Just hearing from Lufthansa, a spokesperson making comments by telephone saying the following: they do not expect an impact from Russia's flight ban. They go on to say they will continue flying south of Russian airspace to Asia. Will mean a change to get there, a change for China, South Korea and Japan. They are the comments from Lufthansa this morning. The bottom line, they do not expect an impact from that flight ban. Coming up, oil soaring amid mounting energy concerns.
As of today, there is no disruption in oil supply through Ukraine.
More on that conversation coming up, and a conversation with this man you do not want to miss. Pierre Andorran, the founder and CIO of Andorran Capital Management. That's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
President Putin's decision to pursue his aggression against Ukraine is a terrible strategic mistake, for which Russia would pay a severe price for years to come. We must stand ready to do more, even if it means we have to pay a price, because we are in this for the long haul.
The West ramping up sanctions on the back of recent escalations. Goldman's Jeff Curry expecting President Putin's latest actions to shift the energy narrative in the U.S.
It was very clear from the West energy was off limits. But what happened yesterday is a clear escalation in potential sanctions, and the fact that energy now is being an industry that is being reconsidered as being off limits.
Joining us now is Javier Blas, our brilliant Bloomberg opinion correspondent and columnist. I want to start here, Javier. Even if they want to carve it out, can they carve it out? That's something you've been thinking about over the weekend.
Well, they can carve it out in some ways, and we have seen the U.S. Treasury has issued a general license that allows to continue paying to Russian banks that have been sanctioned and even have been disconnected from SWIFT. The energy payments are authorized, and it includes, it's very wide definition. It includes anything from crude oil to refined products to natural gas to even uranium or timber. So they can continue paying, but there is a huge amount of self-sanctioning by the banks and by the traders. We may see that officially nothing has been blocked, but unofficially corporations, companies are taking a different view.
That's the word I want to pick up on. Javier, thank you for it. If you're not following Javier Blas on Twitter, you should, because he's going to give you everything you need to know about what's happening with the commodity market. This man will too. Pierre Underrod, the founder and CIO of Underrod Capital Management. He joins us now. Pierre, fantastic to catch up with you. Let's just start with an open one. How you expect the sanctions that have been announced to shape the flows of commodities out of Russia into the rest of the world?
I think, as Javier said, there will be some self-sanctioning. So, we can already see the Urals is trading at very large discounts, and there's no visibility on how the sanctions will evolve. So even though for now the sanctions are not targeting energy export, that could change over time. So there's some fear from anybody to buy Russian oil at the moment. But I would say that prices are not going to be only dependent on that. But I can answer that later.
No, please do. What do you think they'll be dependent on?
Okay. Well, first, before the Russian invasion of Ukraine, the market was already very bullish, and I expected to see much higher prices than today. So I think a large part of the rally is not only due to the Russian invasion of Ukraine, and the main fundamentals are that already inventories are very low, there's very little spare capacity, there's very little expected supply growth, and there's a high expected demand growth due to the recovery of COVID. So already just that, should justify much higher prices than today. Then the Russian invasion, changes could change potentially a lot of things, but we don't know yet how it's going to pan out. Things could get better like soon as things could, get much worse over the long term. So I don't think oil prices are only going to be dependent on, the amount of Russian oil we lose over the next few months. I think there's a lot to it. There's, if Putin stays in power and carries on the tensions and there's no de-escalation, the sanctions will stay. That will impact Russian production in a big way. That will eventually impact Russian exports as well. And that will also impact an acceleration towards alternative energies, towards the energy transition over time. So there's like a lot of factors at play. It's not only about how much oil production we will lose from Russia today.
Well, decarbonisation was at the epicenter of your thesis. When I look at some of the fund's performance for you, Pierre, I saw one up more than 100% in 2020. In 2021, I think up more than 30%. I'm wondering now, Pierre, and I'd love your view on it, whether this shift to decarbonisation accelerates or reverses because of what we're seeing play out. I hear the likes of the Italians talking up coal again. The Polish looking at maybe doing something as well. I just wonder from your perspective, do you think it accelerates it or reverses it?
No, it has to accelerate because so far we did some work on reducing the supply, but not on reducing the demand. So I think we'll have to do a lot of more work on reducing fossil fuel demand alongside supply. So the supply should actually go down after the demand, obviously, so that we don't have price shock and we don't give more power to countries like Russia.
Russia has the power, seemingly right now, because everybody wants a carve
yes,
out.
But I think they think they have more power than I think they really have. I think there's room, if needed, to put sanctions on Russian oil exports. I mean, Russia is exporting 6.5 million barrels a day, about 2 to 2.5 million barrels a day going to China. So that leaves like 4 million barrels a day going to Europe or the US. If we were to sanction that, I'm sure that 1 million barrels a day of it would go to China, which means that we'll probably lose 3 million barrels a day of supply. This is an amount that the world can afford to lose to some extent. I mean, if we lose that supply, the Gulf countries will probably increase production by 1.5 million barrels a day, and then we'll probably need to reduce, to take some oil from the IEA emergency reserve, so the global SPR, at the rate of 1.5 million barrels a day. And that's without, losing some demand due to higher prices. So
yeah, that's a slightly controversial view. Can I just jump in and pin you down on that?
Sure.
You think that Europe could move on without Russian gas, without Russian crude?
No, Russian oil. Russian
oil specifically.
Russian gas. Russian oil, I don't think is too much of an issue. And, Russia is getting 5 times more revenues from oil than gas. So I don't really see too much of an issue. At the end of the day, there's a lot at stake here, right? We're speaking about potentially World War III starting, and that needs to be stopped as soon as possible. Obviously, there will be cost, but there will be less cost trying to stop it early than trying to stop it late, right? There will be less human cost and economic cost in trying to stop Russia right away and show that we're serious and that we're willing to take a cost. I mean, there's one reason why Putin thinks he has the power and is kind of bullying the world is because he thinks we are not ready to take any economic cost. But I mean, we are speaking about a war on the free world. It's not, it's not a small thing, right? Yeah. I mean, there will be cost to it.
No, I hear you. Goldman Sachs think that the only remaining balancing mechanism left in the commodity market, crude specifically, Pierre, and I'd like your opinion on this, is demand destruction. That ultimately crude prices go higher from here, but that kills demand, and that's how we're going to balance this market. Do you agree with that?
Yeah, I mean, I agreed with that even before the Russian invasion, right? I think we have to take oil. I mean, why now? As I said earlier, we have low spare capacity, we have low level of inventory, we have low supply growth and still high demand growth. So we should bring that demand growth back down. We have to take it as something that's a bit more of a luxurious product and not a birthright. You don't want to, this oil to actually, support autocratic regimes around the world.
I know you've got really strong views on the SPR release as well. Pierre, you've seen the headlines. I've seen the headlines this morning.
Yeah, I mean,
we made this effort at the end of last year. Seemingly we're doing it again. Do you think it moves the dial at all?
I mean, I think it needs to be done for the right reason. I mean, using SPR to try, to bring prices down is a no-go. Like we're at the beginning of a multi-year deficit. So if you start using the SPR early in the multi-year deficit is, shooting yourself in the foot. You need to keep that for the right reasons. And I think the SPR has always been there to bring more supply when we have large supply disruptions due to geopolitical shocks. And that's probably what we will have over the next few months or years. So the SPR should be kept for those events, not to manipulate prices, but and that the way it was always used in the past is using SPR due to large supply disruptions from a large producing country. And I think it needs to be used for the right reason.
Pierre, as we work through your conviction trades right now within some of the portfolios, the funds, what is the number one? And I know a lot of your views right now coming into the weekend, coming into the last few weeks, you've maintained them. I'm more interested in the views that have changed. Pierre, have any of those views changed?
I think there's more, question mark. I mean, I think on oil, I'm still as bullish or slightly more bullish than before, because if anything, we're losing, going to lose some supply. Eventually, we lose some demand too, but at higher prices. But overall, the price would have gone up in oil. So it makes me more confident about the low probability of a move down, on the way. For gas, I think it keeps it supported. I mean, basically, it's in line with the fundamental views, right? Oil and gas in Europe would be supported over time, and I think that makes it even more supportive.
You know what I've seen in history, you've seen it too, that typically you get above 100 and strange things happen and it's not sustainable. Pierre, do you get the sense that things are different this time? Goldman's talking at 115 on Brent over the next month.
Yeah,
I'm trying to think about what numbers you're thinking about and how sustainable you think they are.
No, I don't think that $100 is unsustainable. I don't understand why people would think that. I mean, we had a period from 2011 to 2013 where Brent was $111 in average, which is $150 of today's dollars, and the economy was okay. That was during the European crisis, and we had a large supply growth in US shale at the time. So I don't see why people would think that $100 is
hot take for
the high of 2008 at 147 is equivalent of $222 today. So I don't know why suddenly people think that $100 is so high. Sure, it's only because they thought that because of US shale, we'll never see $100 again, but that was a wrong view to start with. I think the economy can support it. The economy can support 120, 130, 150. It's just really psychological. I mean, I remember in 2004, when I was quite bullish, oil was at $33 a barrel. And I thought due to the long-term fundamentals that oil would go up to $100. And at the time, people thought that $33 would kill the US economy. And that was obviously proven wrong. I don't think there's so much impact on the global economy. I think it's a lot more, inelastic than we think.
Pierre, awesome, as always. It's been too long. Let's catch up again soon. Stay close, please. I'd love to catch up through the next couple of weeks. Pierre, underrun there on the situation in the commodity market. $100.61 on Brent. The news coming from Fanny B-Roll of the IEA. We will hold an extraordinary ministerial meeting.
Okay, so what's up, guys? Right now, give me 1 second. Let me stop the music in the background. Okay, so markets seem to be finding some kind of support. So, buyers have, finally decided to step in. Regardless of the situation that's happening right now, I think things are still pretty tense over there. But Ukraine and Russia have agreed to, hold a meeting. I don't know if you guys have been here since the live stream started, but that's what they've been talking about pretty much for the last 30 minutes. Even though there's, hopes of talks, it's not decisive. It doesn't mean that the war is over. It doesn't mean that we're out of this just yet. It could just continue to get ugly as the day progresses, or as the week progresses. We might have 2 days of kind of calmness, and then the real madness starts. See, we're having banks sell off, so that means that if banks sell off, probably tech is gonna start doing good. So right now, the main entry that I have right now, it's Apple, because it's at the support area. It already showed a lot of buying pressure, the last 2 days. So it's only right that it continues higher. How high can it possibly get? You know, you have this 168 area, or around 170, 171, I would say. Those will be the next support areas where it's likely to then bounce. You know, you would have Apple do something like this: go, 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 and then consolidation here. Then it'll probably turn back down, or it could continue going higher. It's terrible, but I hope you get the idea. Go up, or consolidation and support, and then here decide if we continue on the uptrend or we're gonna consolidate, continue lower, whatever the market decides to do with that stock. Same thing with Microsoft. The thing about Microsoft is that I would like it to be above this moving average. Why? Because the moment that it breaks, all four of the main moving averages, it's kind of like a sign of downtrend. So right now we're literally starting a downtrend. If we were to break past $300 and then start pushing up, you could then say, okay, then we found support. But just right here, you see that Friday, it came right up to it, and then it got lower today. So it could kind of do the same thing today. We could see this run up all the way up to $300, and then turn back down. Because it's such a strong support area that if it was above it, it's now a buying support area. But the fact that it's beneath it, it's a support area for selling. So that means that we could come all the way up here and then start to sell off. Look at it. See, so what happens when you're underneath this area? Any bullish entries, any bullish days don't tend to have a follow-up. What kind of follow-up do I mean? This kind, since we're at a support area here, the moment that buyers come in, you see the continuation throughout the days of that uptrend. So ideally, you would see gap all the way up here above this moving average, continuation of uptrend. But the fact that we're below this could easily mean, reversal, continuation of this downtrend. So we just have to wait and let that one sit for a little bit. But Apple is at a perfect spot. I mean, you could tell why, because look, every time it's around this area, it gets bought up, bought up, bought up. Oh shit! Look, perfect example right here. It got sold off all the way down to the 200-day moving average, and then look, we had this huge uptrend the weeks following that. So we're at a very, very good and crucial area right now. Okay, so going back to what I was gonna say, the fact that we're down here, uptrends are not they don't tend to be followed through as they were if you were an actual uptrend with all the support areas underneath you. So a perfect example is Facebook. Facebook broke this trend line. All of them. So now all of this is seller pressure. So whenever buyers step in, you have all these support weighing you down. So it's very hard to see the continuation, because see the bounce out of this area. And as you can see, it just keeps failing, failing, failing. We got to keep on watching it because it's insanely oversold right now, but it could just very likely continue to be sold because it's now officially in a downtrend. So that one I'm not even gonna waste my time with. See, we have the same thing with Netflix. It's finding support around this area, but it's in a downtrend. So even if it shows me a clear bullish entry, doesn't mean I'm gonna take it because we're in a downtrend. So what tends to work better in a downtrend? Bearish entries, puts. Amazon, same thing. Google, same thing. See, silver had a sell-off right here, but it's holding this support. So that means that we're exiting this downtrend that silver has been on for how long now? Since June, pretty much. Oh, I broke it. Yeah, July. Since July, we're finally exiting this downtrend slash consolidation that it was in. So now whenever we have a bullish entry here, it's more likely to work out. So this could mean something. This means that people are probably starting to, you know, divert some of their money into these commodities. Like a Tesla finding support. It's a pretty good entry if you guys want to take it. The thing is that I'm not big on Tesla. I'll probably still check out the contracts, but I don't really love it. See, out of these two, GM is now on a downtrend. Ford is in a downtrend as well, but out of support area. So that one we have to keep an eye on. You know, all airlines are doing really bad. As you can see, they're all in a downtrend. Downtrend consolidation. These two look pretty good. See, they're holding support. See, so this is another thing. If banks decide to hold, tech won't go anywhere. See, tech is starting to sell off now because the banks are holding. So it's like a complicated move because it's like what are we gonna get into? You get into banks and you get into tech, you know that one or the two is gonna do really good and the other one is gonna do really shitty. Because if banks decide to gap higher tomorrow, tech is gonna gap lower. It's just how they move, you know, they move inversely. Or the gap is gonna be significantly less. Shit. So let me start looking at entries and seeing which one of these, if they were to have a bullish day, if they were to have a continuation the next 2 days, which one of these contracts, which one of these stocks is has the most valuable contracts. See, these two are solid right now. But I know from experience that both AMD and Nvidia, just to buy their contracts it's just a pain in the ass. And not only that, the spread is not even the spread. Well, the spread it's insane sometimes, but the actual strikes are so far from each other, and the prices don't value good enough, you know. So a 1% move in here doesn't equate to pretty much nothing. It's probably like a 10% move in the option contract, or a 20% move, you know. So they're not that valuable. They're not that profitable contracts. You know, it's really difficult to make any money off of them actually. Same thing on a video. More profitable ones are obviously the cheaper stocks, so Ford, Tesla's, forget about Tesla. Contracts are probably $4,000, $13,000 and shit like that. I haven't traded in a minute. These are like, middle tier. Probably get these for, I don't know, probably anywhere between 80 and like $30. Depends. For both Apple and Microsoft. But then Bank of America, you kind of have the same thing with Ford, where you could probably find them real cheap. You could find them under $30, $20, $15 per contract. So let's take a look and see.
Between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19 they didn't have access to their documents about this, but they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years.
However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, 1 kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. Asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in.
Carbon capture and storage can remove more than 90% of CO2 emissions from industry and power generation. This technology is one of the ways ExxonMobil is advancing climate solutions.
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000!
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets and you would see people there talking about buying options in that stock, and it sort of squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I am about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act.
Wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that